Welcome back. Dan Oweiler is with us today, President of Sterling Financial Advisors.
How are
Always
you,
good
Ken?
to see you.
Good to see you.
Now, we're going to talk about something called the Rule of 100. You've talked about this before in the past. And really what you're talking about here is kind of the risk tolerance. Should I invest in stocks during my retirement?
Well, people always talk about, how do I invest my money in retirement? And there's been a rule, what they call the Rule of 100, which has been around for a long time, which basically says you take 100, you subtract your age, and that's and the answer is the percentage of stocks that you should have, or percentage of your portfolio you should have in stocks or at risk. So as pointed out, if you're 73 and you subtract that from 100, get 27% of your portfolio should be at risk during your retirement.
Exactly.
Obviously, the older you get, the less percentage that should have. Now, what that doesn't take into account is a couple of things.
Yes.
One is your risk tolerance to begin with, and so you have to realize that risk tolerance comes into play. And so you might say, well, 27% is okay, but I don't want any of my money at risk. So that rule kind of gets thrown out the window if you end up having very low risk tolerance for volatility.
Exactly. And then the other part to that, the other factor is how much interest or return does the retiree need to live comfortably in retirement? And that's on your other slide here that shows that.
Yeah, basically what happens is you have to kind of sit down and determine how much income or interest do I need to earn on an ongoing basis in order to maintain my current standard of living. Well,
we all know what that is now.
Yeah, exactly. So you have to realize that, if you go and put all your money in the bank and you're earning, 1.5% if you're lucky, okay, but you have to earn 3% or 8% or whatever that number is, you can't just keep everything in the bank just because you want to have it safe.
Yeah.
So there's a balancing act here. That Rule of 100 has to take into account a couple of things: your risk tolerance and whether or not you need more income than just sitting it in the bank. What I have found over the years is that sometimes people want to keep their money growing and in the market because they don't want to run out of money.
Right.
Okay, that's the big issue for the people that I work with now, and that's because we don't have pensions like we used to.
Right.
Okay. Basically, when we retire, most of the time, unless you're a teacher or a public employee or something, you end up getting your 401k. They shake your hand and say you're on your own. So people are always worried about running out of money. Well, that's kind of what we do when we sit down with people, is kind of determine what kind of return do you need in order to maintain your current standard of living or the monthly needs that you have.
Exactly. Along those same lines is that years and years ago, people people went into stocks quite often because of the dividends that they were paying, and that sort of sufficed, sort of like an interest in a way. Well, as you know, a lot of these companies, the biggest one you can think of is Apple, they don't pay dividends anymore. It's more about how those stocks are going to go up in value and less so about the dividends.
Well, they're still dividend-paying stocks. Some of the S&P 500 stocks, they're still good dividend-paying stocks, but Apple or some of these other tech stocks are growth stocks.
Right, exactly.
They don't pay any dividends. Their return is based upon the growth of the stock itself. What I will say also is that the market today isn't the same as it was when you and I were growing up.
Right.
There's much more. The internet has played a big change in the volatility of the market, giving people more information more quickly. And so that has caused more volatility in the market than it is today. It used to be, my first experience in the market was back in high school. It just keep going and going and going.
Right.
Now there were corrections from time to time. In 1987, they had what is called Black Monday.
Right.
Market went down 25% in one day. Okay. 2008 was the most recent one that we've had. Year ago, Brexit voted, and the market went down 6% in a month. It's kind of recovered from that now. So we're in an 8-year bull run. I know we were getting, I guess he's probably in by now. The new president's probably been inaugurated, and we're looking forward to maybe some more growth or more jobs or whatever it is, I'm not sure how long this market's going to be able to continue though. Because if in fact we do get into a trade war with China or Mexico or something, that's going to affect the stock market, and we might have a correction and a pullback as to versus just this continual growth that we've had over the last 8 years.
Yeah, I know this morning, I don't know if we've hit 20,000 yet, but it went up quite a bit this morning. I don't know.
I haven't seen it yesterday. We did a seminar last evening, and I think it was at 19.8 or something.
Yeah.
It got close to that 20,000 mark. It's pulled back over the last week or so, but at some point it's going to hit that.
Yeah.
And at that point, you got to say, am I still going to do I want to take the risk of maybe earning 8% or protect my money and earn, 3 or 4?
And as you've said over and over again, it depends on the individual.
Sure.
How much, another thing you've said, well, how much can you afford to play with or lose? Not that you want to do that, but sometimes you have to look at it that way.
I ask people when they come in, how much of this money can you afford to lose? And 95% of the time, it's, well, I don't want to lose any of it. Well,
what is it, Paul? 19,800 right
19,000, about 800. Yeah, that's what I thought.
And what's interesting? You go back to 1987 when the market lost 25%
in one day.
Well, 25% back then was probably 500 points at most, maybe closer to like 350. Now, if you use 350 in one day, you're like, okay, it'll be back up.
Exactly. It's all relative, but that's, I mean, the market was probably at 2,000. Here we are 10 times later, but still it's percentage-wise, it was a big impact then. If you ended up losing 4,000 or 5,000 points in one day, that would catch our attention again.
Exactly.
Okay? So it's all a percentage of what's happening, but at the same time, people always come in and say, I'm 65, 70 years old, where should I be putting my money? And that depends on your risk factors. And so we've talked about this before. We do what I call our retirement weather report, which kind of forecasts your needs for income, and we kind of analyze your investments, and we do that at no cost, just to give us a foundation of where we're going forward, because sometimes people feel like, well, I've got to keep my money growing at X amount so I don't run out. Well, this report kind of tells you, based upon certain assumptions, what your income, what your assets are going to be in 30 years. So So you don't maybe have to feel like you have to get 8% and take the risk. Maybe you only have to earn 3 or 4 to be able to do that. So you can cut back on the amount of money that you have at risk, which would give you more peace of mind.
Exactly.
And so it really is a personal thing. As we sit down with people, it's hey, I'm getting ready to retire. I can't afford to lose this money. Well, if you can't afford to lose it, there's only certain things you can do with it. And so we have to discuss the options there available to them.
And unfortunately nowadays the interest rates aren't what they used to be.
Well, they say they're going up, but we'll see.
But even if it does, it's going to be incremental.
Right. Now, and I mentioned this before. What Congress may or may not know, or they did an analysis that if interest rates go up 1/4%, the servicing on our debt will increase $400 billion a year.
Yeah.
Okay.
That's amazing.
So just politically, I'm not sure that interest rates are going to be going too much higher, because the servicing on our $20 trillion debt is just going to be impacted so greatly.
Exactly.
So it's really kind of a fine line here of getting back to normal economics, is what I call it, as opposed to this artificially low interest rate environment that we have.
Yeah, we're not going to see those 11 and 12%.
Well, not in. I think those days are gone.
Yeah.
Because the world has become addicted to low interest rates.
Yeah.
I mean, the amount of debt that all these countries have and everything, they can't afford a 5% interest rate.
Right.
Just because the servicing on the debt is so great.
Exactly. Well, as Dan said, you can stop on by and get a free consultation, and I think it's really important that you do so, because especially if you're at that age that you're just retired or getting ready to. There's so many different factors to look at.
Our seminar season's starting. We've got some things up on the bulletin board that I think show some different dates over the next 2 or 3 months. And if they'd like to come to one of our seminars at Ruth Chris, they can give us a call or call the the number on the invitation, and be happy to have them there.
Yeah, exactly. We put those up, and I think you have like 6 dates coming up. Am I right?
We've got
back to back.
Yeah. We go in over a 3 or 4 month period. We have 12 seminars.
Yeah.
So
check out the website sterlingfa.com. You can get information there. And you know, it's a good thing to just kind of get a little peace of mind.
Sometimes what happens is our greed button gets stuck.
Exactly.
You know, the market's going up, and we feel like, hey, we're not getting part of that, so we get a little nervous. But it's a lot easier to sleep well at night, is what I call.
I totally agree. All right, folks, that does it for today. Dan's going to tell you the weather right now. Is it raining?
It's still raining.
It's still raining.
Still raining outside, which is good. I mean, you know, they say we're out of the drought, or 50% of us are, but probably by the end of the weekend, most of us will.
I think we will. All right, folks, you have a great weekend.